Well, hi everyone, welcome to the Buffett and Beyond Research Stock of the Week, and we're going over Adobe this week. And folks, is Adobe beginning to lag the rest of the computer stocks? And we're going to take a look at that because Adobe was one of the better computer stocks out there for a long time, and well, let's just see what's going on. And remember, folks, if you want to live on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. Don't forget that if you want a full free month subscription to any of these videos that we have, we put out 3 a week, 3 different videos on a Saturday. You get the 3 videos, and on Tuesday, Wednesday, Thursday, and Friday, you get a letter on the market and timing the portfolios. All we need is your name and email. We want you to get a free month subscription so you can see what we're all about. All you have to do is go to buffettandbeyond.com. Buffett is spelled with 2 F's and 2 T's. buffettandbeyond.com, and give us your name, your email, and you'll start getting a full month free subscription to our letters. And let's look at Adobe. Well, they develop various computer software products that enable users to create, transfer, and print electronic documents. And in fiscal 2022, the company operated in the following primary business segments: digital media, digital experience, and publishing and advertising. And Adobe's leading software products include, and folks, you all know these, Illustrators, Photoshop, InDesign, and of course Acrobat. And it has about 29,240 employees, so it's a pretty big company. And let us look, now this is last time we went over Adobe, which was 6, 7, 8 months ago, and the green line represents Adobe, and these are 5-year averages, and the blue line represents the average stock out there. And we found out that the average stock in the S&P 500 is about the average stock across all the large indices. So we compare Adobe using the clean surplus methodology, which allows us to compare against the average stock. So the clean surplus return on equity, think of your bank account. Would you rather put money in a bank account that's giving you a 13.5% return on equity, or one that's giving you 21%? So the clean surplus ROE is a comparable across all stocks. That's the beauty of this clean surplus relative to traditional accounting. Now let's look at income. Income was way up 19.7% versus the average stock at 13%. Revenue up 16%, while the average stock up 7%. So it's, in some cases, it's doubling the average stock out there. So everything looked good up until about 6, 7 months ago. Now let's bring this chart up to date. All of a sudden we see this starting to go down. Let's go back again. Yeah, about 6, 7 months ago, the net income was leading the average stock by a nice margin, and now it's falling below the average stock. Revenue is still there, but they're not bringing it to the bottom line, so we have a little problem here. So let's take a closer look. And what we want to do is look at this clean surplus return on equity. Now, to get into our growth portfolio, we want to see a clean surplus ROE of 20% or better on average. That's for the average portfolio. So in other words, we could have some stocks that have a below 20% ROE while others have above a 20% ROE, but the stocks have to fit in. That's what a portfolio is all about. The stocks have to fit in and complement one another. It's not just a group of stocks. So we see Adobe was doing real well up until 2021, and then 2022 just started falling. This year is having a difficult year, but it's supposed to, or predicted to, come back a little bit next year. But notice we have 4 numbers here, including projections for 2025, that are under 20%. And when we look at these averages, this is the 10-year average down here, 5-year average ROE, and the 3-year average ROE. And you can see these are starting to come down little by little. Now, what does the clean surplus return on equity actually measure? It measures that the money or the company is making money indeed, but when you see lower numbers like this, then we could say that the earnings are growing, but they are growing at a decelerating rate. You see down here, when we had this group of over 20%, the earnings were growing at an accelerating rate over 2017 and 2016. So accelerating growth in earnings. Now all of a sudden, the growth in earnings still growing and growing nicely, more than the average company of 13%, but the earnings are starting to decline in their acceleration or deceleration. Yeah, they're putting all the money back into the company that they're making, which is good. But this net income growth, we see the 5-year averages, this net income should be about 13%, and it's not. So here's where we're falling down this year, 2024. Expected to rise again for 2025, but when you translate it into clean surplus equity, it's not that 20% that we're looking at. Now the revenue growth is above average. The revenue growth for the average stock is 7% or so, and this company is doing better than the average stock. So we have a little dichotomy here in that the revenue growth is not transferring into net income growth. So something is going on here. Now let's look at what this company has done over 5 years. The black line, this is price. Black line is the S&P 500, and we can see that Adobe was doing real well. This is 1920, 1921, 22 when the market was down. Adobe really fell. And so did most of the tech stocks. The tech stocks and the semiconductors did fall more than the general market. Why? Because, and how do we compare that? The S&P 500 fell almost 20% during this time period here, but the NASDAQ fell about 34%. So yeah, the tech and semiconductors fell more than the average stock because they had gone up more than the average stock. And then all of a sudden, this stock started regaining its composure, and I'm talking about Adobe, and then all of a sudden started taking off, and now this year, 2024, it had a tough year in here, starting to come back a little bit, but boy, oh boy, we're looking a little askew at this stock to remain in our growth portfolio. It's not in our top stocks in the ETF portfolios. It's not in any of those. It's just in our growth portfolio, and we're not sure we're going to keep it in there by the end of the year. Remember, we change our stocks right about the end of the year if any changes need to be made, and then we rebalance. So we just have to see what's going to happen here, but we're not too excited about Adobe staying in our portfolio. We'll just have to wait and see. Over the past 1 year, black line S&P 500, you can see where it has had trouble this year. And now it seems to be coming back with the market quite a bit, reaching recent highs in here, not former highs, but recent highs right in here, and we'll just see what has to happen. But Adobe has been disappointing us this year. And then just yesterday, bad news, the stock fell a little bit. It's not shown on this chart, but it fell a little bit, so it's giving us more ammunition to say goodbye Adobe. Not sure yet. It's still a better than average stock, don't get me wrong. Let's look over 5 years again. Better than average stock, so it's a pretty good stock, but there are better stocks out there. So folks, we had a very, very good week. This market came roaring back this week, and we like to talk about Fridays because if the market closes up on Fridays, that means the traders out there and the other market participants are pretty confident in themselves because they have to wait Saturday and Sunday before the markets open again, and they're willing to take a chance on buying stocks on a Friday. And we've had 5 out of the past 6 Fridays positive, so we're looking pretty good. Even though we're in seasonal weakness, which boy oh boy we did for the first week in September, it wasn't pretty at all. And then this past week, looking pretty good. So folks, you go out, you forget about the market. Get your mind back on your family, go out for a walk, be alone, get your head, clear your head, and have Sunday dinner with your family. And folks, most of all, be safe, and we'll see you back here with our Tuesday morning letter.